Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the July investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the markets and what we think you need to know about the investment universe right now. Welcome back, Bob, to Wealthy Behavior.
Thank you, Sammy.
How's it going? What are you thinking about the markets these days? I know we've been talking a lot about the Fed, inflation. Markets have rallied quite a bit since October. We avoided likely any debt ceiling nonsense. There is the possibility of a government shutdown maybe later in the year. What's on your mind this month as you think about the markets?
Yeah, I think where we left off the last podcast, talking about the soft landing, and we're nearing the end of the Fed raising rates, and it looks like they're probably going to raise rates at the next meeting, which is in late July. I think July 25th and 26th. A 25 basis point increase is probably coming, and that might be it, maybe one more, but we're nearing the end of that, and seeing if we can pull out of this Fed rate hiking cycle without the economy hitting a recession, which seems to be the most predicted recession in history. Everyone was calling for it for the last 18 months, and still might come. That's what we're watching, and then with that kind of comes, if they pull it off, start of a new bull market, and we've had a nice recovery, and could be legs to it.
But you and I have some concerns about what you just shared with the Fed possibly raising rates 2 more times, because there's a disconnect, right? The Fed is saying we didn't raise in June. That's a pause. Doesn't mean we're done. In fact, we're specifically saying we're not done. But the stock market, at the very least, seems to be ignoring the Fed.
Yeah, the Fed, they've been saying, I think Powell would say 2 rate hikes this year, and the market is pricing in about a 70% chance of 1 rate hike next meeting. And then I think if you go later in the year, it's like a 90+%. Like the market, they're off by about 1 hike. I think by year end, the market sees maybe 25 basis points, and the Fed is saying more like, no, it's going to be 2. And then
Bob, let me just stop you there. Is that a huge disconnect?
That by itself is not huge.
Okay.
So it's like market says 1, Fed says 2. Okay, so we're off by 25 basis points. Where the disconnect grows and is more important is in 2024, where the Fed is, we're going to do 2 and then hold. And the market says, no, you're going to cut.
Okay.
And earlier, like when Silicon Valley Bank went under in March, the market was saying you're going to cut this year. And the Fed said, no, we're not. And look, now the market agrees. The market agrees you're not going to cut this year, but it moves to next year.
Well, Bob, what are the ramifications of the market being disconnected from the Fed? It's basically that if in either direction, but I guess in this specific direction, if they're assuming less hikes and cutting sooner, that the market is more optimistic than they should be based on what the Fed is signaling that they're going to do. Is that the risk to investors?
No, it's more the market. When you think about why would the Fed cut rates, it's the market is saying no Fed. It's what Professor Jeremy Siegel would say, a policy error, which the Fed is well known for doing. They raise rates until something breaks. They raise rates until a recession comes, and then they save the day by cutting rates. So the market says, hey, we've seen this playbook before. We know how it goes. Fed raises rates, cause a recession, inflation plummets, then you cut rates to get us out of the mess you put us into. So that's more what the market is expecting in pricing. And this is the Fed funds futures markets, which ties to the bond market, not necessarily the stock market, even though in theory they should be connected. But I think the bond market, Fed fund futures market, is still pricing in a chance of a recession, and the Fed needing to cut rates.
So what that is telling you is that the real risk is that the market is saying the Fed doesn't need to do 2 more, and they may overdo it.
Right.
Got it. Okay. Sorry, I interrupted you. Where were you going with the rest of that?
No, I think that's it.
Okay.
Yeah.
So are the stock market and the bond market telling us the same thing about future rate hikes and cuts?
It's a tough question. I wish I knew. The bond market, you can tell by pricing. So you can look where yields are, and especially things like the Fed funds futures, like you can literally see what is priced in. The stock market, you can't really talk to it or tell by the price of Tesla how many rate hikes are priced into it. But what I think we have seen is a disconnect in prices. Some companies, there's a pretty big spread between value and growth this year. I think there's some maybe companies that are a little overextended, have gotten a little too hot. Where you look at valuations have kind of run away. And then another good segment of the market that hasn't participated much this year. So it's tough to really take blanket statements about what the market's thinking about rates when you move it to the stock market. But I think there is a little bit of exuberance in the stock market in some pockets, specifically those that are under the AI umbrella.
And we talked about NVIDIA before. Are you thinking of that basket of stocks?
Yeah, the whole, it does strike me as too much this year as far as market participation from companies that are involved in AI. When you think about it, AI has been around and in the similar forms that it is today for decades. Like self-driving cars, research started on that in the 80s. I remember hearing about, there will be self-driving cars a long time ago, like decades ago. And IBM with Watson beating Gary Kasparov in chess, and winning Jeopardy, and Ask Jeeves, which was maybe the original Chat GPT.
That was terrible.
But the technology was there, and it's gotten better. And the Alexas and Siris, and like we've had AI devices. I mean, even at Heritage with our trading system, we use third-party software, but it's like a form of AI with a human behind it. But the stock market is really focusing on AI this year, and it's like if you're doing AI in 2023, you're golden. And it does strike me as a little almost like a sonic boom, like it just kind of hit. And the question is, was it underpriced and under-recognized for the last 2 decades, and it's catching up, or is it overreacting? And tech has been in favor for a good part of the last decade. I don't think that these companies got ignored. So I lean more towards we're seeing a bit of an overreaction in markets as opposed to an under. So it's just something I just be a little careful there. For any listeners who are tempted to go out and stock pick AI focused stocks, I'd be careful.
Be careful. And would you be taking some gains if you had a concentrated position in those areas?
Yes.
Yeah. I just looked, by the way. Ask Jeeves is still a functioning website. I don't know if I'm going to ask it anything, but then you mentioned Alexa and Siri, and all of that stuff is in that same vein, right?
Yeah. I looked before the podcast. I looked into IBM to see what they were up to, and it was Deep Blue was the software that beat Kasparov in 1997, which is pretty cool. I mean, beating Gary Kasparov in chess, and then it turned into Watson, won Jeopardy. And I remember seeing a 60-minute special on what Watson Health was doing, and it was acting like a radiologist and oncologist, I think at Duke Health in North Carolina. And they sold it to a private equity firm in January of 2022. So they've moved on from Watson Health, which I thought was interesting. But anyways, there's been a lot of work in that area, I think, is kind of the takeaway. It's not all a 2023 story, and yet the stock market's reacting pretty heavily to it this year.
Understood, Bob. You're doing Gen X proud, doing the greatest generation proud by your continued skepticism and I'll believe it when I see it mentality on AI-driven stocks. What else is on your mind as you think about the market? A lot of times we start this podcast with an update on how things have gone since the last time we recorded. And the big thing is that the market on June 8th closed 20% up from its October 12th, 2022 low, right? So market was up 20%, a little bit more than 20% since it bottomed in October of last year, leading some people to declare, hey, we're in a new bull market, because that's one of the many definitions of a bull market, which is a 20% rally off the bottom. And I wrote a little bit about that on the Boston Advisor post that came out a week ago. Are we in a new bull market? Because as I started to dig into it, there's a lot of different definitions for what is actually a bull market. And I wanted to see, what they were and which ones resonated. And to me, at least, if you ultimately retest a low, so you rally 20%, but then you go right back down to where you were last October, as an example, it's not necessarily a new bull market as much as a rally within a bear market. That's the way I've been taught, that, market cycles are peak to trough to peak. And I had your colleague who's been on the podcast before, Michael Waldron, our director of portfolio management, run some numbers. And you can rally 20% off a low and ultimately retest those lows. It's happened 3 times. So it doesn't happen often, but it has happened 3 times. So with that maybe overly long question directed at you, what are your thoughts about when a new bull market starts and whether we're in one?
Yeah, it's an interesting discussion. You may know I'm not a huge fan of putting names around market price movements. The one that my biggest pet peeve is a correction. And when markets go down 10%, oh, it's correct now. It corrected. I just think that's kind of goofy. Like it's something that's broken that needs to be fixed. But stepping back, looking at market cycles, so there's financial market cycles and bull markets, bear markets, and there's also economic cycles. Economic cycles, expansion, contraction, trough, then you expand to a peak, and recessions are the contraction part. And in the textbooks, typically what you'd see is they about overlap, but the market moves about 6 months in advance of the economic cycle. So, the economy is expanding and contracting over time, over decades, and the bull market is running during the expansion, and then it's bear market right before you have the economic contraction. So and if you look in history, like you go back to some of the last severe bear markets, like you take the one in 2020, the COVID crash, that came with a recession. So you had the economic contraction, and that was all kind of simultaneous along with a recession while the stock market was going down. But then you had the financial crisis, 07 to 09, where you had a contraction with the bear market, tech bubble, again, contraction, bear market. So this time around, getting to your question, are we out of the woods? Is the bear market behind us? What's a little puzzling is, where's the recession?
Right.
So that's the part that makes me pause, and I think jury's still out on that. I would find it would be a little unusual historically to have a bear market and not have a recession.
Not completely unheard of, but
no,
unusual.
Exactly. It definitely has happened, and it's not a couple times. Like it's happened, but I think it's something like 60% or so of 20% declines come with a recession. So that is the one thing. So it's what's going to happen on that front, and is the market pricing in, say, a recession in 2024, which maybe there's 50-50 odds of one happening, or is it more like what Lisanne Saunders and the folks at Schwab have been calling the rolling recession? And it's, it never really came all at once, but there've been bits and pieces. Like we saw the layoffs in tech, we saw 8 months of home price declines. Now we're seeing stress in commercial real estate, like, here and there, but never just all at once textbook recession. So it's, to be determined on that front.
So I was just going to ask you what you thought about that concept of rolling recessions, and you're saying it's possible, right?
Yeah, it is very interesting. I guess there's, one of the most dangerous terms in finance, this time is different. And so this time, and Lizanne knows that, so she would never say, this time is different. It's going to be a rolling recession. I had never heard of that. I don't think anyone had used that phrase before, but like tech kind of did go through it last year and they're out of the woods, maybe. So it definitely is plausible.
So if you're utilizing the definition, which I did in the piece, that a new bull market means you don't ultimately retest the prior bear market low, you're not going to know for a while whether you're actually in a new bull market or not. But in your mind, the biggest concern is we haven't seen the economic slowdown that everybody, which you earlier said, has been talking about, in the most, heavily predicted recession hasn't materialized, and that's still hanging out there. And the Fed could keep doing what it's doing, and that could cause a bigger slowdown than what the market has already priced in this 20+% rally.
Yeah, the concern would be on two fronts. It's the lagged effect of monetary policy, which is coming. And second, there's a story that people probably start hearing more about over the course of the year. And it's the household savings from COVID stimulus. If you look at like cash in the bank, people's savings accounts before COVID, and then when COVID hit, from a combination of government stimulus and especially early on, people spending less money, like you weren't going to Disney World and you weren't going to restaurants. Consumers it got close to $3 trillion in household savings, above pre-COVID levels. And that near 3 trillion number is being spent down. And it's kind of, you could draw a line and say it looks like it's going to be depleted by later this year, around October. So that, the government put a lot of money into the economy with all kinds of programs, and people were not going out. So they built up the rainy day funds, and now they're going on their vacations, building their, decks and things. And that's good for the economy, but it's not sustainable. So that is kind of looming as an issue that could be coming later this year.
So we talk a lot about this, and then we try to bring it back to the individual investor and what you're doing in portfolios. Is this just things that you're aware of and a little bit of noise because we're building long-term portfolios, and these short-term issues may or may not cause you to go in one direction or the other, or are you actually contemplating, or have you been making asset allocation changes or investment changes based on what we just talked about?
More of the latter. We have made some changes, and rewinding the tape a little bit, it was in December of 2022. We increased risk. So we stepped on the gas with equity and increased the equity allocation to get pretty aggressive. And we did well through that, and then we kind of unwound that a little bit within the last month or so, by just getting more back to a neutral stance.
And why was that, Bob? Why did you increase and why did you unwind?
So the increase was a combination of the sell-off that we saw. So we saw that big decline in stocks. So we viewed stocks as attractively valued. And then the unwind is, well, then they rallied. And we think rallied, maybe not quite too far too fast, but enough that it's like, that this is maybe not the time to be too hot on risk. And what made that decision a lot easier was that bonds are attractive, bond yields are higher. So with investing, it's something I always say is, with every buy there's a sale, with every sale there's a buy. And like looking at stocks in isolation, that's one thing. But when, in core bonds, you're getting close to 6%, that's compelling. So with stock valuations where they are, we got back to neutral from overweight.
I was just going to ask you, what should people expect in a high quality investment grade bond portfolio in terms of yield right now? Not short-term stuff that you're seeing in money markets or the 2-year treasury, but in an intermediate term bond portfolio that's got good credit quality and not a lot of risk to it, what yield are you expecting?
Yeah, not the 5 to 6 range.
Okay.
Yeah, we're seeing, especially in the securitized market, where like commercial real estate mortgages, there's more risk there. For our listeners, Sammy just grimaced. It's a commercial real estate, but yields have gone up a lot in that space. So some of that, but then, just overall with corporates, treasuries, a diversified mix, you get like 5 to 6%.
Are you thinking that credit risk is something to take in this environment, or are we not being compensated for owning lower quality bonds that yield a little bit more?
It's more you don't need to.
Okay.
When you can get 5 to 6 in the high quality space, you don't really, if you're looking for double digit type returns, I'd prefer to go in the equity market. More keep the bonds high quality, and that's more what our managers have been doing, kind of getting good yields on the mid to upper end of the quality spectrum, rather than going bottom fishing.
Okay. And as we've, or at least I have, made a little bit of a circuit to some industry conferences in the second half of this year, probably more so than I've done in a few years, for a variety of reasons that will completely bore our listeners to tears. But one of the takeaways that I've had is, yes, you get past, in the investment conversations and presentations, you get past the Fed and the Fed bashing or the Fed praising and the inflation conversation. Another theme does seem to be something that we've talked about extensively that I want you to hit on again, is this plug for international diversification in your stock portfolio. So, as a reminder to listeners, what are your thoughts on international investing, and how have international markets done, and why maybe am I hearing it everywhere we go from investors that we do respect?
It's definitely something interesting. We've had a global approach, so this is nothing new to us, but we think the opportunity is quite strong right now. And what we're seeing are favorable valuations overseas compared to historical averages, while in the US we're seeing valuations that are maybe a little expensive, a little above historical averages, so the spread is pretty wide. Okay, so in the US, looking at PE ratios, the S&P 500 is at about 18 times earnings, which the average over the last 20 years for the S&P is about 16 times earnings. So 16's average, it's at 18. So it's a little high. That's about one standard deviation above average. When you look overseas, you see a PE of about 15.0, with the average being 16.8. So a little below compared to average, whereas the US is a little above. If you go to emerging markets, it's at 12.9 times earnings, and the average there over the last 20 years is 14. So both emerging and developed international are below their 20-year average, while the US is above its average. So I think that it's a pretty big spread that just points to opportunity there. Got it. Okay. Thank you, Bob. Anything else on your mind, or things that your team is looking at from an investment standpoint these days? No, I mean, one thing that came out this morning that was a little surprising, Case-Shiller real estate index. It's a 20-city composite, and there were 8 consecutive monthly declines. So we saw pullback in residential real estate. Last month, we saw an increase, a break of that trend. So rather than a 9th in a row, it ticked up once. And then today, it was about, I think, a 90 basis point monthly increase. So that trend has changed, and close to a 1% increase in a month. So it looks, we're seeing some early signs that the residential real estate market might be back. And for our local listeners, Boston was pretty high in the list as far as performance. I think it was the second hottest market. So we might be seeing the residential real estate market turn, which, playing into is inflation dead? Is the Fed done? It's, not what they want to be seeing.
Yeah, that is interesting. I had not seen that number. Thanks for bringing it to our attention. Anecdotally, I would say from our friends, colleagues, clients, and family members who are trying to buy houses, they have said that the market has not slowed down around here, but I know that it has in other pockets of the country for sure. Bob, one last question, I guess, before we go. What are you reading these days? What are you looking forward to digging into over the summer, just to kind of keep connected with what's going on in the world?
Yeah, so two book recommendations. You did give me the courtesy of thinking about this one. So for our listeners, one book called Against the Gods: The Remarkable Story of Risk by Peter Bernstein. And it's a favorite of mine. I've read it a couple times. And nerd alert, this is for people who like math and history. It goes back to like the ancient Greeks and Romans, and talks about math and basically kind of the development of probabilities and statistics, and takes you from then all the way through the mid to late 90s and the evolution of financial markets, and how, like, without being able to calculate probabilities, or maybe when they figured out how to calculate probabilities for gambling purposes, that led to the launch of the insurance industry and eventually the broader financial services, and some of the developments in financial services, like modern portfolio theory and things that we use today. So for people who get into the industry now and just think that everything that we know today, it's not like it's been around forever. Some of the stuff's only a few decades old in the history of the world. So it gives you interesting perspective. It's a well-written book. So that's Against the Gods by Peter Bernstein. And then a second one that different tune, different audience, call it maybe an easier read, Principles by Ray Dalio. So Ray Dalio is founder of the world's largest hedge fund, Bridgewater Associates. He has kind of like an engineering mindset, very systems based. Talks about machines, like his company, it runs like a machine. And principles are kind of his rules for operating this machine. I don't know how many of them there are. It might be like 150 principles, but each one, there's like a page or two on it. And it pretty wide ranging, but it's also interesting when you look at it kind of stepping back. A lot of the principles relate to human capital. And at first you would think, oh, well, the guy who runs the biggest hedge fund, it's an investment book, of course. But if I were to say who should read this, this is probably more for really anyone in management, even someone who's in like HR, because so much of what he does, it's about getting the right people on board. So a lot about recruiting. Then you have the right people on board. Well, how do you manage them? How do you, constantly supervise and make sure that you're getting the most out of them? And just an interesting book, interesting person. He can be controversial with some of his things, like on the extreme end. I think they say that at his company, there's like cameras and microphones in every room.
Right. The radical transparency notion. Yeah.
Exactly. So you have something to say it to my face. Don't, no gossip. And so he has things like that, some people say that, that's too over the top. And, like a lot of books, sometimes it can be a little too extreme in some areas, but you can still get the essence of it. Yep. So, and that's a book, like, especially in the summer, if you're busy and you just like pick it up 15 minutes here and there, you can, with the way it's written, with all the principles, you can just read a couple of them at a time. It's like a coffee table book. Got
it. Awesome. So Bob is a serious man. No crime thrillers, no beach trashy reads. You pick up Principles, pick up Against the Gods. Those are your book recommendations for the summer. I love it. I've read them both. You've recommended them both to me. I enjoyed them. And in the interest of time, I will say that I share a book recommendation, usually once a week, through the Wednesday reading list on the Boston Advisor. And most of them are actually non-business, non-investment. So if you're looking for a different direction, we've got you covered through Bob and myself. Bob, anything else before we wrap up?
I'm good if you are.
All right. Have a great 4th of July weekend. And I appreciate your insight as always.
All right, thanks, Amy.
How to Build Your Next Million. Heritage Financial's newly released ebook teaches investors about the tools and strategies that can help them save, keep, grow, and protect their assets. This free ebook can be accessed in this episode's show notes and on our website at heritagefinancial.net. Today is a great day to learn how to build your next million.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast or that of the speaker are subject to change and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal.